Happy day girls. So today we will be covering one of the topics from advanced corporate accounting, that is amalgamation, absorption and external reconstruction. So coming to the first term, have you heard of Maruti Suzuki? Definitely you might be. So in 2013, Maruti Udyog Limited and Suzuki Motor Corporation merged together and became one company. So that how it became Maruti Suzuki. Okay. And another example which happened recently in 2018 is Vodafone India were merged together with India Cellular, okay, and became Vodafone Idea company. So these are the mergers happened, and lots of mergers, other mergers also happens, and why it happens. So we'll be going through that in the later part. So coming to the term amalgamation, or in another term we'll say it as merger. Okay. So when two or more companies join together to form a new company, it is called amalgamation. So for example, you can see here company A and company B joined together and formed a new company which we can call as AB company. Okay. So in this process what happens is company A as well as company B will be liquidated, and then it will form a new company. Okay, so the examples are Maruti Suzuki, Vodafone Idea, etc. Now coming to the objectives of amalgamation. So when two or more companies join together, it actually avoids competition because your rival company becomes your own company, right? It avoids competition, it brings in diversification, multiple products will be there from multiple companies, and it helps in diversification. It helps in tax benefit, like for capital gains from amalgamation is exempted from tax. Also economies of scale. It actually helps in reduction of purchase cost, so it helps in economies of scale. Then it brings in broader customer base. So when you purchase or merge together with another one or more companies, what happens is your customer base will be broader, it will be more. Okay. And it also helps in acquiring resources. So when two or more companies merge together, your resources will be more, right? So these are the objectives of amalgamation. Now coming to another situation. So there were lots of, you have heard of SBI, and there were lots of associates of SBI like State Bank of Travancore, State Bank of Hyderabad, State Bank of Bikaner and Jaipur, State Bank of Patiala, State Bank of Mysore. So these were the associates of SBI. And in 2017 what happened was all these associates were acquired by SBI. So no more there is SBT, that is State Bank of Travancore, State Bank of Hyderabad, all were acquired by SBI, and there is only one bank, State Bank of India, and thus it became the largest bank in the country. Okay. So this process is called absorption or acquisition. Okay. So when one existing company takes over another one or more existing companies is called absorption. So here what happens is, say here company A acquires company B, that means company A eats company B and become a bigger company A. So here what happens is company B will be liquidated and it will be merged together, or it will be a single company as company A. Okay. Another term coming is external reconstruction. Here what happens is an existing company will be liquidated and a new company will be formed with the same shareholders to take over its business. So here company A liquidates and then it will be formed as company B. Okay. Now coming to the types of amalgamation. There are two types of amalgamation. One is nature of merger and another one is nature of purchase. So there are few conditions under nature of merger. There are 5 conditions under amalgamation in nature of merger. If these conditions are satisfied only, it will be called as amalgamation in nature of merger. Okay, so we'll just go through what all are these conditions. All assets and liabilities of the transferor company, that means the selling company, should become the assets and liabilities of the transferee company. Transferee company is the purchasing company. Okay. So all the assets whatever is there with the old company should be taken over by the new company. That is the first condition. Second one, shareholders not less than 90% of face value of the equity shares of transferor company to become the shareholders of the transferee company. So, minimum 90% of the shareholders of the transferor company should become the shareholders of transferee company. Third one, the consideration for amalgamation is discharged by transferee company wholly by shares. Okay. So, the form of payment is only through shares, and if there are any fractional shares, it can be paid as or in the form of cash. Okay. The fourth condition is the business of the transferor company, that is the old company, should be carried on by transferee company after amalgamation. So, if a company is acquired, that business should not be stopped, that business should be carried forward or carried on by the new company. And the fifth condition is no adjustment to be made in the book value of assets and liabilities of transferor company when it is taken over by the transferee company in the books of transferee company. That means when say company A is the transferor company, company B is acquiring company A. So, what happens is the assets and liabilities of company A should be taken in the same book value in the books of transferee company. Okay. So, except few in case if there has to bring a uniformity in the accounting policies, then only changes can be made. Okay. So, coming to the second method of amalgamation, that is the nature of purchase. So, here basically the thing is, if any of the one or more conditions of nature of merger, amalgamation or nature of merger is not satisfied, then it becomes the nature of purchase. Okay. So, if the assets and liabilities of transferor company is not taken over by transferee company, less than 90% of the shareholders of the transferor company becomes equity shareholders of the transferee company, or the consideration paid is in form of cash or shares or a combination of any of these. Again, the transferee company will not be or may not be carrying forward or carrying on the business of transferor company, and also the assets and liabilities of the transferor company may not be shown in the book value in the transferee company. So, these are the two methods of amalgamation, one in nature of merger and one in nature of purchase. Thank you.